So today we are going to talk about fixed income, 6th of July, 2022. So the content for my presentations today, they are consists of mainly 4 topics, and these are very relevant. Number 1 is liquidity cycle. This is where we talk about, if you read the Straits Times or Business Times or any of the publications, or even you are hearing our minister is saying that, recession is coming, and we learn to be prudent. There's a lot of headwinds, a lot of what we call negative words out in the air. And why is that so? That actually a lot has to do to this liquidity cycle. And of course, I'm about to talk about what is that, right? The second part is a big topic, interest rates. Now, interest rate is traditionally a very complex subject, all right? It actually is one whole big module, in the university academically. But today we are just going to focus on how interest rate affects the market, and more importantly, how is it going to affect you and me, if you have loans, or if you are doing a business loan, or even if you are investors, how you can actually take advantage of the interest rate, right? And then the third one is, is to go through some of the fixed income tools that we have learned during the lesson, and now being able to identify which are the ones that will suit us during this kind of environment. And lastly is about Singapore saving bonds. These tools. The question here is that, is it really worthwhile to go into Singapore saving bonds, at this time? So these are the 4 main topics that I will cover in the next 1 hour and 15 minutes or so, right? So number 1, liquidity cycle. I know over here I put American flags here because it sounds like it is a US market. No, the liquidity cycle, it actually applies across every country, right? So this is, some people call it an economic cycle. You can also call it a liquidity cycle. It actually goes in the range whereby you start off with interest. Maybe I'll go the other way around. All right. So when the COVID hit us on in the mid, or rather early of the 2020. So what happened was that there was a panic. People were afraid that the economy would not be able to move on because of the lockdown and things like that. The Fed actually reduced the interest rate a lot, if you recall those times. And as a result of that, the stock price has been rising, coming from a very low point in March or April 2020, and it went all the way up, to 2020, November 2021. I think that was a peak, right? So the reason why they want to do that is because there's a lot of QE in process, or what we call the stimulus program, is to kickstart the economy and hoping that the economy will recover, at that time. Which it does, because the market start to flood with money, and because of the cheap money available, people start to use that money to do a lot of different type of investment, right? Or even speculations to a greater extent. And this somehow or another sort of like boost the economy recovery, right? Economy recovery, which is what we have witnessed over the last probably all the way until November last year, and then of course subsequently this year it started to come back. But this is what we actually witnessed for approximately about 18 to 20 months, from May, or rather March or April 2020, and continuously 18 months, the economy has sort of like boom, and in fact at this point of time, the economy is so-called overheated, right? Overheated. Now, when the economy is overheated, obviously, the next thing is the inflation. right? Which is what we are experiencing right now. So the inflation today is being caused by various three major factors. All right, three major factors. Number one is the war at Ukraine, right? The Russia-Ukraine conflicts. Second one is the supply chain breakdown due to China zero COVID policies. And so these three main reasons are basically the ones to cause the price increase, right? Because number one, when you have the logistic global supply chain breakdown, means that there's a lot of commodities, goods not being able to ship up. The war between Russia and Ukraine basically affect two things. Number one is food, and the other one is energy, right? So with these inflation rises, what will happen is that, in fact, I would say during just before the inflation rises, what happened was that the bond price falls, and nobody is looking at bonds at all. Very simple. It's because when stock market is rising faster than fixed income, obviously nobody will be interested in looking at fixed income, right? And therefore the bond price basically fall. The coupons that's offered by the bonds was actually low. So there is really nothing for people to, there's no reason for people who want to look at, pathetic kind of a 3% or 4% bond yield, that sort of things. So then you have your inflation rises. Now, when this inflation rises, this is basically where we are in today's world, right? This is basically where we are. Inflation rise and interest rates rises. So this is where we are right now. And these three come together. So then you have your stock prices fall. So even as we speak today is 6th of July. By this month, Fed is going to increase 75 BPS, which means that the interest rate is going to go to 2.25. There will be another meeting coming up, and they are talking about 50 BPS. So that will mean that eventually it will go to 2.75, right? 2.75. So as this interest rate keep rising, the stock price will fall. So when people talk about recession, they are not, you don't have to look at them and say that, wow, they are so clever. How did they know a recession? No need, because 10-year series will tell you after this liquidity cycles, you know that the recession is coming. So we are not worried about recessions. We are only worried when the recessions will come. Right? It's not about having recessions. Recessions will come. Is the time, right? Is it going to be next year? Is it going to be the year after next? Or is that what this government, or different central bank is trying to do to prevent these recessions, to prevent these recessions? So the concern is the time. It's not the event, all right? And obviously at this point of time, as an investor, you want to look at it and say, okay, it's recession, what we can do now? What we can do to prevent, that we will fall into this trap. Or even if it's a recession comes, then what we can do during these recessions. All right. Then with that, the next one will be the bond price rise. And then the inflation will fall. And then this cycle will repeat again by itself. So it's called the liquidity cycles, right? History repeat by itself. No one can avoid it. If you track back to, if you're using a long historical period, of cycle of the economy, these things has been going round and round and round and round. So it's nothing to fear about. It's just a question of how we can actually prevent this. So at this point of time, maybe it's good that I would ask a questions to the group, sort of like to to understand how much you would read into the financial news. So currently the inflation rates in the US. I'm using US as an example because US being the largest economy and their policies, their monetary policies and that's actually sort of like influence the rest of the world. All right. So whatever they do, somehow or another, it will sort of like ripple to the rest of the world. So in this case, I'm using US as a benchmark. So currently the US inflation rate is 8.2%, if I'm not wrong. Okay, 8.2% is still high. It has dropped slightly from 8.5. My question to the group is that what is the target rate whereby the inflations should be in the US in order for the Feds to say stop? I'm not going to have interest rate increase. Anyone? What is the inflation numbers that they are looking at before they say they will call a stop for interest rate rise? Anyone? Thank you, Del. Anyone? Eugene, 3.4, okay. Anyone? 8. No, 8 is too high. 3, 2.3, okay, okay. Good. So for those who answer 2.5 to 3, no, it's definitely, I mean, if it's able to go down to 2.5 to 3, that would be nice, but I don't see, that is not the numbers that the Fed is looking at. Currently, the Fed is looking at to be able to hit between 4 to 5%. All right, 4 to 5%. That is basically their target range before they will say a stop. All right. So we really have to pray very hard. We're going to pray very hard for the inflation rates. If this month the inflation rates from 8.2, they're going to jump back to 8.5. I am pretty sure that the market is going to be react very, very unfavor to us. In other words, the Fed forecast for interest rate rise will definitely either, number one, the interest rate will rise at a bigger percentage, or two, is that the frequency of increment will increase. So right now we are looking into October, July 0.5, 50 BPS, and then October 25 BPS, right? So if this month the inflation rate, let's say, goes back to 8.5, meaning to say that that plan may change. That plan may change. But let's say if the inflation rates, miraculously, fall to, let's say, 7%, from 8.2, then we may not find the interest rate rise that fast. So market will, from an economic point of view, the market will actually react positively to that. So the inflation rate right now is the major issues right now in greater scheme of things. That's how we will, if you want to have a crystal ball and you want to say, where's the market heading, this is the numbers to look at for now, right? For now, when the market settle down, that's a different story, right? But right now, the whole world, the central banks is tackling one issue, that's basically inflation rates, right? Okay, so by understanding that these liquidity cycles, you have any other questions from you all? Okay, no, that's good. Then I'll just move on to the next one. Okay, so interest rate high for June is that's basically for June. So it's now 1.75. All right, so plus 75, that will be end up with 2.25 going forward from July onwards. Okay. So let's say if okay, sorry, it's 1.75 now. So if plus 75 PPS, that will be 2.5, not 2.25. Right? So that's basically the range of the interest rate in July. And by their projections, they will be looking at 3.25 to 3.5 by the end of 2022. Okay, remember this number, 3.25.355, because this is going to affect you and me in the Singapore market, right? Inflation target rate is 5.2, so it's 4 to 5%, that kind of target range. And unemployment rate has to be in the region of about 3.7. All right. So it's a very strange phenomenon, is that if the unemployment rate fall below a certain level, I can't remember what was the figure, is that if US unemployment rate will really fall to a low level, then that's where the recession will begin. Right. So if you want to look at recessions, and instead of just listening to to people tell you that there's a recessions, then the other way is that basically you want to look at the unemployment number. I think it's 2.5%. Yeah, and then the recession will come in. Anyway, by the way of defining a recession is that 2 consecutive quarter of negative growth is considered as a recession. All right. So let's say if you have 1 quarter is negative growth, then the next quarter is positive, then the following one is negative, then it's not considered as it's not considered as a recession. It has to be 2 consecutive quarter negative growth, then it's considered as a recession, right? There are also economists saying that actually the recession has already started now, right? Because economists can track on the month-to-month growth, and then if continuously, and this is basically the beginning of a recession, whereby you will only have the results by end of Q3 in order to find in order to confirm it is a recession. So let's see the economic data to see whether if it is, if the last quarter Q2 is the recessions, or is it going to be a Q3 is going to be recessions. All right. Anyway, when I say recessions, I mainly refer to US market, right? Because the data here are all the US market based. And again, why am I using the US data? Is because it is the largest economy. Singapore is is a strong trade partners with US. So whatever happened in US, we do get affected, right? So that's what. Right. So how is interest going to affect all of us? So it really depends on which side of the coins you are in. Are you in the lending or are you in the borrowing, right? So if you are the lender, obviously you are also termed as the investors because you're the one who has the money, and you can decide what you want to do with the money. And if you are borrowing the money, then that's a different story, right? Because then you are at the mercy of the lender to decide, what sort of interest you got to pay. So it depends on which side you are on. So let us just go into some of the details to see where we come from. All right. In Singapore, the lending rates is what we call SORA. We used to call SIBOR, SIBOR. So SIBOR is more of a forward-looking interest rate, right? Well, SORA is more of a backward-looking. Now, to calculate this interest rate, that's complex. It's beyond our we need to know for financial gym. So we just need to know that in Singapore, the lending rate is based on much depending on SORA. SORA is highly correlated to Fed fund rates. They are correlated. So that will also means that whatever that's happening in the US, SORA will basically react to what's Fed's going to be. So if you want to look into what is a SORA, that's the link that's provided below. You can you can read it at your own time about Sora, or you can actually Google for the information. Let me just cut and paste over here, and in case you'll be interested to read. So that's Sora. Now, how does this Sora going to affect us if you are a borrower? So this is a 3-month Sora table. 3-month Sora tables for 2022. So you can see that the from January, the Sora was only 0.194. But by July 22, it's become 0.772. And that increase is almost 3 times, 300%. Right? So if I round off to 0.2 and this is 0.7, that's in fact more than 300%. Right? So so that's basically the base lending already, right? Now, when this Sora is come to this level, right, what is the next things to happen is that if you are taking a loan from the bank, right, then this is what you're going to see: 3-month Sora plus 1% per annum, or if you are up to 3 years, then you have 3-month Sora plus whatever they say, and you have your other terms and conditions and things like that. So residential property is considered one of the lowest loan you can get. We have not even talked about commercial property loans, which is higher, business loan or non-collateral loan and things like that. So with all these loans that comes into play, especially business loan, and is keep increasing, then obviously the cost of doing business becomes expensive, right? Because you are a borrower. If you are a residential property owner and you have a loan, such increase from January until today, the difference, they have done the calculations before, is that change, in terms of monthly payment is actually quite significant. We are talking about a few $100s difference. All right. Obviously, if you loan it over a period of 30 years, that's perfectly fine. It's only affect you a little. But if you have a short-term loans, then this increment is actually quite significant, right? Now that's only for residential, but for commercial, that impact is far, far, far greater. Especially when business are running at 30% gross margin, 12% net profit type of business model. This interest rate is going to take away a lot of their profit, right? A lot of their profit, and it's not easy to deal with these kind of issues, right? So that is if you are a borrower, right? So currently, like what we say, during a market downturn, and when the recession hit and things like that, cash is the king, right? Now, if you hold cash, you basically has the loudest voice, in the room, whereby you say, I have cash, and cash can do a lot of things, So that is a huge difference from 6 months ago when there was this economist by the name of Ray Dalio. If you follow his books, his articles, and he says cash is trash, right? So cash is trash is because when the economy is booming and everything is inflated, the amount of cash will never be able to buy the goods that you want to buy, but in the downturn, obviously having cash is always good because it actually conserve your longevity of your financial health at this point of time. So that's all. Now is cash is king for now. So if you are the lender, which means that you are also have money in hand, then it's good because, like I say, cash is king. So this is a time that you can actually deploy your cash into instruments, into institutes, whereby you can earn steady incomes, right? Because of the rise of the interest rate. So there are three fixed income tools. If you recall the the lessons plan that we have gone through, today the fixed income tools that's available is a fixed deposit, and the second one is a short-term single premium endowment plan, and the third one is Singapore saving bonds, right? So when interest rate goes up, these plans become very attractive because all these institutes or even the banks, they need cash. They need cash, right? They need to conserve cash, and in order to attract cash into into their funds or into their banks, obviously they have to raise the interest rate, right? So if they don't, then what will happen is that the money will actually flow to other areas. So in Singapore, obviously, if the local bank is not giving attractive returns on fixed income, then obviously people will go out to other market to buy, put money into a foreign bank, to earn a higher interest. So these are the three fixed income tools that's going to be available today, and I'm going through each of these tonight, and you all can decide for yourself if these tools make sense to you, or at least during this uncertain environment, do you want to keep cash in fixed income tools and waiting for opportunity to get into the equity market? So that's up to you, but I will just go through the three fixed income tools. So the number one thing is fixed deposit comparison. This is probably the easiest comparison. Before we talk about equity and other securities investment, we have learned this when we were very young, is to put money in the bank and we can save and we can earn an interest. So that is what we have learned. So to make a comparison between deposit rates in Singapore in July, this is a table that you all can take a look. I would again cut and paste this link. You all can read it on your own. Now, this website has basically tabulated best fixed income rate in Singapore right now. Hong Leong Finance minimum deposit accounts amounts 10,000, 24 months, 1.88. And if I would scroll down, and if I want to judge by interest rate, it seems that IHB is the best. They give you 24 months, look in with them, it give you 2.25. Right? The rest is actually not too bad as well. But looking at the current trend at this point of time, anything more than 2% is the one that is you should be looking at. Anything less than 2% is probably not, you probably just want to ignore that, filter that out. The only thing that I would look at it other than interest rate at this point is to avoid putting your fixed deposit in the longer potential. So for example, 24 months, 2.25, it sounds good. It sounds good, but 24 months is a little bit long. If you have one lump sum, 20,000 to invest, 24 months, it seems a bit long, all right? If I am able to choose, then I will pick ICBC, 12 months at 1.75, right? I like to look at short-term fixed deposit rather than long-term. If I have only one lump sum, all right, one lump sum to put into FD, I will prefer to look at short. The reason why I want to look at short is because I know that in an interest rate rising environment, these rates will continue to go up. All right. So there's no point for me to commit long term because let's say assuming the Fed is going to, the earlier slides I presented is that the target is 3.5%. Then what I'm seeing is that all these FD time deposit, they will hit a region of around 2.5 to 2.85 kind of a region. All right, or maybe even up to 3%, depends on how long the tenure is. So, so therefore, for me, my strategy is always, me personally, is always look at the shorter terms, and at the highest interest rate. All right, but of course, if it's get too low, then it's not worth it, Personally, because if I have more money, all right, personally, if I have more money, what I would do is that I basically break down the money into different tranches. So for example, 100,000, I will break it into, let's say, 3 tranches. So I can put, let's say 50, 30, 20, all right? So I divided this 3. The 50 one, I will basically put, let's say, slightly longer term, let's say 24 months. And then the 30, I may put, let's say, 80 months. And the 10, the last 20, I may just put into short, 12 months or so, something like this. So the strategy is basically, it's very simple, is that I will let the earlier one who expire and you roll over to a higher interest rate. So this is what we call the, this concept is actually known as, borrowed from a bond concept. It's called the bond ladder, the climbing ladder. Is basically is to stack each of these fixed deposit expiry after one another so that you can continue to roll up your interest rate and get the best benefit out of it with a time deposit, right? So I wouldn't put one lump sum into just only one time deposit slips. I will basically break into a few. This concept is actually borrowed from bond ladder. So you can make this comparison by yourself and decide, what is the best, scheme that fits, fits into your time horizon and your return. Okay, so that's for FD. Question so far, anyone?
Hello, Jimmy.
Yes,
Eric.
Eric, hi.
I just want to share whether is it another alternative.
Yes.
One thing is depend on the age and depend on your CPF account. Let's say I know that if you are able to, because I already over 55, so my full time park the retirement sum is already full retirement sum.
Yes.
And actually, everyone still can contribute to CPF. They will have a ceiling every year. It's 37,740.
Yes.
So if let's say if you're working, let's say your CPF come from your work contribute, let's say 10,000. So actually you're able to top up 27,000 something.
Yes.
So that one, and then they will based on your age and allocated the percentage based on your cohort. And then that one maybe also can give you a a better interest. But the point is, you must 55, and also you have fulfill full retirement sum, and
correct.
You're able to do it. So at least they have one. Just share.
Yeah, you're right. Eric, you're correct. I don't disagree with that. The only thing is that while you deposit money into your CPF after 55, that money is actually fresh money, we're talking about fresh money on top of your employment contributions, that money will only go to OA account.
No, I think that is the amount will go to, I think is based on your cohort percentage. Let's say they have a bracket, 55 or above, and then I cannot remember because the total employer is 28%, 40% by yourself, 40% by your employer. So I think after they can get 28%, they will allocate that medical safe and MA account, SA account, and the OA account. If your MA account is already go to the top, I think it's at 60,000 now or 66,000. And then they will put the money, transfer the overflow in your MA account to your OA account. But your SA account still have some money, still your based on your cohort.
Yeah, I know where you come from. Yes. So my question is that okay, CPF is basically another topic, but what I'm trying to point out is that the money, let's say supposing if I have, you know, $30,000 now, okay, assuming
Right.
30,000.
Yeah.
I can't just put $30,000 and expect to withdraw 30,000 from the CPF tomorrow. I can't do that because the systems somehow or another, like what you say, divided into 4 different accounts: MA, SA, RA.
Three.
Yeah.
They will not. I think that they will not. But I do not withdraw, but you're able to put. You're able to put even you're over 55. But 1 year you can only top. Even now, that even in January, they will proportional about your income. So they will tell you, if you pay, let's say your at the end of the year, your CPF contributions, if X amount, so even you pay the cash, the excess over the 37,740, the extra, they will not give you interest. The end of the year they will give you back. So I think that they are doing this now. So I think this is the catch. I think that there's a one way because it's more flexible because you engage the financial institutes, you engage 12 months, 18 months, 24 months, whatever. But if you go to depend on age if you're less than 55 years old, you are not able to use this because you are not able to take over until you're 55. So I think that is one thing I just want to share. So everyone
agree.
Can explore this.
Agree. Yeah. CPF is definitely one of the systems to game it. I'm not, as I said, I'm not denying it. I also agree with you. It's just that you in order to do that you have to study those policies very, very carefully because your condition is 60,000 max. That means you max up your MA already. You are your FRS, which is already done already. You have your RA already set up nicely already.
A full retirement sum at least.
Yes. FRS, yes. And then you have to make sure that you probably your SA will probably have some money depending if you have shield or not shield. Then your OA will still remain there. So what you do is that what you are saying is that with all these conditions being met very nicely, then you put in the money, you earn the interest, and then you can withdraw at the same time. I fully agree.
There's another way. Just share.
Correct. I as I say, I agree. I wouldn't disagree with that. Yes.
Thank you.
No problem. I agree. I mean, for those who are more than 55 years old, my strong suggestions is to go up there to CPF board, make appointment with them, talk to them. They are super friendly people. In fact, they will actually tell you how to game the systems. And with that, once your criteria is being met, you are pretty sure, then what you can do is that you can actually have a higher interest from the CPF, which is basically if you are doing from SA, you are 4%. OA is 2.6%, very I think it's 2.5%. 2.5. But again, if this interest rate right now is going to be, let's say 2.9 or 2.8, assuming, then of course the CPF game doesn't make too much sense anymore already.
Yeah, correct.
Yeah. So yeah, I mean, as I said, go talk to CPF board about your retirement planning. This one is really important, because I personally have visited them at least 4 to 5 times just to understand, how the systems works only. And they are very kind to spend time to explain to you, very, very patient as well. So they are the nicest people that I've met you know, in I would say among all government agencies, these are the most nicest people that I've met. Okay, so thank you, Eric. Any
welcome.
questions?
Jimmy?
Yes.
Yeah, I just want to check. You look at the Hong Leong Finance, let's say it's 24 months. But it's 1.88 no, but it's 1.88. That means you will break down by per month. I think ICBC has the best gain. Do you agree?
Hong Leong Finance is 1.8, and then which one is the best? Sorry,
I say ICB because Hong Leong you must
oh,
put
yeah,
24 months, right?
Of course.
So you divided by 24 months. Actually, the gain is so much lower.
Yes. Of course, in this case, I would say 12 months ICBC is one of the but it's attractive lah. Yeah, I agree. I fully agree.
So for our layman, that means I will take the 1.88 divided by 24 and see per month how many percent I get. Is that the correct calculation?
You take 1.8 divided by 24 months. No,
Yeah, so,
no. It doesn't calculate that way. You wow, this one. Okay, so I will do this 10,000. So 10,000 multiply by 1.88 per annum, right? So percent. So I get $188 after 12 months. So I divided by 12. 1 month I get $15.60.
Should be divided by 24, right?
No.
Oh, I see.
Per
annum, I see.
Per annum.
That means for the 2 years, I will get 1.88 lah. Am I right to say that?
Yeah, correct. Fixed at 1.8 already. You won't give anything more already. Yeah.
If something like UOB, you like to have like 15 months, the kind of thing, how would I do this calculation?
Wow, this one cheap already. This one I you have to. Okay, this one you don't have to do calculation one. You go to the bank, right, and you just ask. They will computer type with a big slips over there and to calculate for you. So, but if you really want to calculate, you basically take out 12 monds at 2%, and then you divide it by 2 because with a 12. Okay, 12. 15 divided by 15 minus 12, you left 3. So then the other one is
3 times 2% divided by 12 lah.
So it's 20,000 times 2%, which is 400, right? Divided by 12 times 3 months, you get $99.99. So you add back, then you add back the full year 12 months.
Oh, so for this comparison, we have to get to do like a monthly comparison. Is to make it a fair comparison.
You calculate the absolute dollar you can get in return. The absolute dollars.
I see.
Yeah.
Okay. Thank you so much.
Yeah. So you can make those kind of comparisons with different banks, but whatever we calculate, right? You go to the bank, right? The bank will have a different calculation because they will take off. What time you bank in, what time you're going to withdraw, and then they will basically computer tabulate one slip, and then they will basically give you the exact numbers because of the the timing, the first day of the month when you bank in, and then from there on they calculate of it. So they are quite complex on that. And then second thing is that they actually count the number of days, right? The number of days. So over here we calculate by months, but then the actual computer is actually calculate by number of days. So is whatever we calculate here, we will never get it exactly the same as what the bank will give you. So it's best to check with the bank. But over here we actually have a guideline already. We roughly know who are the banks who will be able to give you the best interest rate, right? Just based on just per annum alone, you can actually say which is better really, right?
Thank you.
Yeah. By the way, Vivian, you were talking about Hong Leong Finance is actually better deal. ICBC is a better deal. That's incorrect. Hong Leong Finance is still a better deal because it's give you per annum 1.88.
Oh, I see. Okay, because I want to divide by 24 months.
No, you don't do that. You look it per annum. That's why they say PA per annum.
Okay.
Yeah, so
understand.
you don't, and then you can't divide interest rate by 12 months. It doesn't work that way.
Okay. Thanks.
Yeah, per annum. So in this table itself, the best one is still, if you look at just per annum interest rate, is still 2.25. It's still the best, still from IHB. Okay, and then the second one is BOC. Okay, right. So yeah, so for those who are looking into time deposit, this website is probably a best guide for you. To check out which is the best rates, and then you can head down to the bank and inquire. And of course they will have the different time period as well. So Bank of China, they will probably give you 8 months, 12 months, 15 months, 18 months, 24 months, and then they will have different rate. Make those comparisons yourself, right? So this is fixed deposit. Any more questions? Okay, if not, then I'll move on. Okay, so so this is fixed deposit. The next one, which is equally interesting, is what we call short-term single premium endowment. This is super popular by a lot of retirees, offered by insurance company. As far as I know, is that the Great Eastern Single Premium Series 7, $10,000 and 2.3% per annum. This has been fully subscribed already. You can't buy it anymore. So you just have to wait for the Series 8 to come out. And I believe the Series 8 that comes out, it will have offer a higher interest rate, right? So currently still running is this one, 2.3%. TIQ 3 years endowment plan. And then this is also fully subscribed. Manual Life Go 9, this is only up to 1.1%. So the disadvantage, so this is basically a single premium endowment. So that means you buy one lump sum, 10,000, and then you get back the return with a 2.3% per annum guaranteed plus principal. So it's like a time deposit as well. So to me is that this single premium is good, provided that you don't need to visit the bank, but the policy itself, it runs the same way as time deposit, in terms of investment, all right, in terms of investment. Of course, with this single premium endowment, they may have some insurance factors, I'm not sure, but you can, go and look out for the details. They act like time deposit. So if you are looking purely from an investment point of view, again, in today's market, this may not sound too attractive now. It was 2 months ago, but now it may not be. And I'm pretty sure that the next series that they're going to launch, they have to up the interest rate. Okay. So this is a single premium endowment. Now, the last one I want to talk about is Singapore saving bonds. You all have heard about Singapore saving bonds. I'm not too sure how many of you all are into it. But Singapore saving bond has in the headlines in recent weeks. The average return has hit a record high for 3% for August issue. So this is considered as high for today's market. And what are the things that we should look into? All right. So so going back to comparing Singapore saving bonds and CPF, obviously Singapore saving bond in terms of flexibility is much flexible than CPF, right? And if you are looking into just ordinary account, the interest rate is only 2.5%. So it's really becomes unattractive, right? Because once you compare, 没有比较就没有伤害啊. So when you start to make this comparison, then you realize that, hey, maybe CPF is equally not that attractive, right? Some more you have to clear so many hurdles. So so what is Singapore Saving Bond? So Singapore Saving Bond is open for subscription for each month. All right. When it is launched, when Singapore Saving Bond was being launched, MAS actually sort of like committed that that they are going to launch these bonds every month continuously for 5 years. Now, right now, I believe it has already passed the 5 years mark. So whether are they going to continue to launch these bonds or not, that we do not know. As far as we know is that for the last last 3 months or so, SSB is continuing to issue every month, right? So the interest rate of each month to Singapore Saving Bond is correlated to Singapore government securities funds, which is basically a long-term yield funds. And this fund is basically based on their earnings generated, right? So then obviously the earnings of this Singapore government securities yield itself, it is somehow another interest related as well. But how it's being related, we do not know, because that is again through a very complex mathematical calculations. So let's leave that aside. All we need to know is that the Singapore Saving Bonds itself is interest rate sensitive, right? So it uses 1 year, 2 year, 5 year, and 10 year SGX as a benchmark. So it looks very similar like US 10 years T-bonds treasury as well. It actually used 1, 2, 5, and 10 years as a benchmark to calculate the yield curve. So that's something that we would need to know as a background. Now, what are the features of these Singapore Saving Bonds? Number one, it is issued by MAS, right? They are capital and interest guaranteed by the Singapore government. And obviously, it is a AAA rating. Now, the features that this bond is interesting is they call it the pay step up interest each year up to 10 years. So what it means is that you begin with year one with, let's say, at a slightly lower interest rate. As we move to the second year, the third year, the fourth year, and the fifth year, the interest rate will just keep going up. All right, so that means to say that the interest rate is been increasing over the period of the tenure. Now, this is basically a very good feature compared to time deposit, because time deposit is that the bank actually wants you to commit to a fixed interest rate, right? Then even if the interest rate goes up, the borrowing cost from the bank is still low because they borrow from you at a cheap price, slightly lower rates, right? So as an investor, obviously you do not want to tie up by the bank. You want your fixed income to go up, to accept to grow, with the rise of the interest rate as well. So this Singapore Saving Bond suddenly become really, really interesting, right? Now, minimum investment is $500, maximum $200,000. All right, and because this Singapore Saving Bond is not something, it's issued by MAS, right? It's not an institute nor organizations or anything like that. So you can't trade this bond in the secondary markets. So there's no secondary market available. Either you buy from MAS and you sell back to MAS. There is no middleman in between. All right, there's no middleman. You can't trade this in the secondary market. Unlike the conventional bonds, whether it's going to be a CapitaLand bond or whether it's going to be UOB, DBS bond, those have a secondary market. When they issue, the bank say, not my problem anymore. I got the money I want, I'm happy. Then the rest of the bonds is float in the market, and you let traders, trade in and out of their bonds. They don't care. Right? As far as they are concerned, is that their bonds is already in the market. MAS is different. MAS is, there's no secondary market. You buy from MAS, you sell back to MAS. That's it. The other thing is that it shows in CDP statement. Right? So when you have these bonds, you buy from MAS, Singapore Saving Bond, how do you know that you actually own that bond? You actually show up in your CDP statement. Now, come to this point, I want to ask a very interesting question. I see whether you can answer me or not. Why is it important that your bonds show in CDP statement? Anyone? Make a wild guess. Why is it important that your bonds is shown in CDP statement? Yes, Jonathan, it shows that you own it, but that is not the reason. You own it. So why is it you want to show that you own it? Tax? No, bond has no tax. Singapore, when you make money from bonds, it has no tax per person. I said there is an advantage to have Singapore Saving Bonds show in CDP. And that advantage is actually to your advantage. So tax is not to your advantage. Come, anybody think.
I just make a wild guess lah.
Yeah, can.
Because if somebody not around, the guy passed away lah.
And
then maybe your family can be notified, something like that. Because if you buy something, if you do not able to trace back, actually whatever you buy and become Akong one. But I think that if you do it in CDP, probably you can get something a family. I guess lah.
Okay. No, it's a proof of ownership lah. When there's a CDP, it's actually you're quite close already. You're quite close to my answer. But from what you tell me, yes, I agree. You want to be you want to have recorded so that if you pass on or if we pass on, at least somebody can actually take that statement and say that
yes. For example, when you go through about the probate, so it will be much easier and you have centralized record. But you can imagine if somebody buy some bank, put some money in the bank, the bank will not looking for the owner. So I think that on this planet, so there are many banks actually swallow a lot of this kind of money, especially some secret society. Eventually they have some problem. That is a big gray area. So I think that. So I think that is one of the reasons. I guess only.
Yeah, I mean, you're not wrong. Logically, you're correct. I'm not saying you're wrong. It's just that it's not the answer I'm looking at. And that's not the main reason as well. No counterparty risk, and I think Huiket has actually answered that because there's not able to trade, so there is no such thing as no counterparty risk as well. So that's also not the answer. Okay, but Eric was actually quite close. Eric is quite close to the answer. So when you have that Singapore Saving Bonds reflected on your CDP bank statements, it actually says that you are the ownership. You are the owner of this piece of this bond. So my question to you, is this bond a liability or asset? Asset, right? Okay, thank you very much. So when I can prove that this is my asset, can I go to the bank and take a loan from the bank or not? Thank you, Brian. You can take a loan from the bank. You can take a loan from the bank. So if you are buying SSB $200,000, be it you accumulate to 1 million with SSB, all right, you have that interest that that generate for you every month, every year, or whatsoever, you know. Then one fine day you say, hey, this property is nice, I want to buy this property, can I take a property loan? And the bank say, hey, you don't have cash, you know. You say, yeah, you paid the first 20% down payment, blah blah blah. And then after that they say, hey, I want to take a loan. The bank say, hey, you cannot fulfill this, you cannot fulfill that, you know, God knows what is it. Then you tell the bank, hey, I'm rich. No, I'm rich. The bank, tell me how it's rich. You bring your CDB statement to the banker, to the loan department, and say, nah, this is my $1 million Singapore saving bond. They will actually give you a loan based on that. They will give you a loan based on that. All right. So this is what we call I won't use the correct word should be security loans. All right, security loans on that. So it can actually give you loans for that. So it becomes a piece of paper that is worth a lot of money if you put all your assets under that CDB statements. All right. Now, how much will the bank loan you? Of course, that will depends on their policies. But in general, what I'm trying to tell you is that when you have your SSB in your CDB account as a CDB statements, it can use as an asset and can be used as a collateral to take up a bank loan, right? So,
Jimmy, no, sorry to disturb you. So I'm thinking, what is the logic? First of all, there are two things. Because on this line, I show that the maximum, is it individuals? They have maximum is 200,000, or every time or every year he can buy 200,000?
Oh, no. This one is every time when you buy, each month, the minimum investment for SSB is $500. The maximum you can buy as an individual is only 200,000. If you have 1 million, you cannot buy. You can't.
Yeah, okay. So you can see the logic. If you're using these assets on the CDB and then this SSB as a assets to borrow money. So how come the return, you get it, the interest, the income from these bonds, SSB should be much lower than you pay for the interest.
Of course.
Money from, so what is logic? You better maybe sell this back to the SSB and get the cash, and no need to get the loan from the bank.
No, you're right. I'm only saying that this can be used as a collateral to borrow money. I never say that you must take and borrow money from the bank.
but that makes sense. Let's say if you borrow the money, you pay the interest is higher, then you get it from this bond. So most of the people, they will rather, I guess now, we rather sell this away, sell bonds away, and then no need to.
Yes and no. Yes and no. It depends. Really depends. There are so many ways in planning your cash flow. So, for example, if I have 1 million SSB, and I do not want to sell because it's giving me 2.3 whatever % that is given to me, and for some reason I need a short-term loan from the bank. And yes, the bank is going to charge me a higher interest, but I'm not willing to sell my bonds. So what I'll do is that I will take this as a collateral to borrow short-term money from the bank. All right, I pay the high interest, but the moment when I make money from my venture, I can actually repay the short-term loan to the bank, and I still keep my SSB.
Okay, I'm convinced. Thank you.
Yeah. I mean, there are so many ways, you know, to plan about. I only say that you can use your asset in your CDB account to borrow money. I never say that I never say that you are using this to generate incomes. You know, I mean, obviously the bank is not going to be stupid, right? And they are not going to lend you at the interest rate which is lower than your bond, than your Singapore saving bond. Let's put it this way. But if you have a basket of a high yield bond, assuming that the bond is paying you 7%, and the bank is loaning you, let's say 2.something% for your home loan, for example, then there's still a difference in the interest interest spread. If that's the case, then it will make sense for you to say, you know, I take a loan from the bank because I'm paying lower, and then I have more cash in my pocket by pocketing the difference, the spread of the interest. You can do that. There are a lot of people do that as well. So there are many ways, as I said, there are many ways to you know, to look at financial instrument. More importantly is that you know, is to tell you that they are these are basically asset. You know, this is basically asset, and you can actually go to the bank and borrow money using it as a collateral. It's only a tool right now. Whether you want to use it or not, that's a separate story. You know, whether is it going to use it, whether it's for short-term needs, for emergency needs, again, that's individual, right? Okay, so any more questions?
Jimmy,
yes.
When it comes to the step-up interest, I remember last time although I think the earliest slide, you mentioned about, I didn't catch the figures in from the newspaper. You mentioned that recently, is it 3%?
Yes. Yeah, I'm going to show you later.
No,
I'm going to show you.
The 3%, is it the end of the 10 year, right?
Yes, end of 10 years.
I think starting from the first year, I think it's less than 2%, much less, maybe 1.5%.
I'm going to show you later. Yeah.
I think last time I remember this. This is why I do not consider, because I look at that. If they're only 10 years, the end of the 10 years, I only get 3% or 2%, 2.something%. So
yeah.
this is not attractive, lah. This, I think last time in my mind, in my thought, I still have this idea.
No, don't worry. I'm going to show you the next slides.
Not at least we have some interaction, right? If you know discussion, also very boring, right?
Yes,
okay.
agree.
Okay, good, thank you.
Yeah, no problem. I mean, I welcome the discussion. Just that whether how you look at the interest rate step up versus the tools is in the current market compared to even a few months ago is completely different. And that's why I bring up this topic, SSB. If you know, for the last 2 years, I don't remember I even talked about SSB because the return is so pathetic, right? But in today's market, with what is going on in the rest of the world, you know, I bring up this, you know, Singapore Saving Bond is to highlight the features and for everyone to consider that it is worth the time and effort to, you know, to look into that. You know, it's not a right or wrong, or it is something that you must do. Is something that for you all to consider, and that's the point I'm trying to make. So the other features is that you can, different from other institution bonds, all right, the Singapore Saving Bond you can redeem, all right, you can redeem at almost at any time you want, but of course there is a window period, right? The window is 6 p.m. first business day of each month, and then 9 p.m. Of the fourth last business day. So which means that you have almost one whole month, you have to less off the first day and the last 4 days, almost 1 month to redeem your SSB, you know. And then the money to credit by the end of the second business day of the following month. So so once you redeem, and then you will see the money will comes in on the second business day of the following month. So what it means to you is this: if let's say if you redeem on the first business day of each month, then you need to wait almost 1 month, you know, to see the money comes to the bank account. But of course, if you redeem on the last 4 days of the window, then you will see the money comes to the bank account within a week. So it really depends on on when you actually do that redemptions, right? And the money you can get is basically is a principal plus interest accrue. So you are going to get the full amount that you have invested plus the time of the interest that's been accrued during that period. There's no penalties or fees for early redemptions except the $2 transaction fee based on what I read from the website. So there's no such as like institution bond. There is always a penalties. There's always, if you're talking about single premium, there's always a penalty. Even if you put in time deposit, in the fixed deposit, if you redeem earlier than what you committed to the bank either charge you an interest or they basically will impose a small fee for early redemptions, But for SSB, there's no penalty. The only fees that I read is the transactional fees. That's all. Okay. Does it allow for partial redemptions or full at the point of subscriptions? I believe these come in tranches. So when you subscribe in one single tranche, then when you redeem, you will have to redeem as a full. But I'm also inclined to believe that because it works on a unit, so if it's, let's say, if it's go by unit, then you can actually redeem partially. I do not have a clear answer for you. I will have to check and then come back to you on this as well. Because they don't issue use on a per dollar basis. If they use it per dollars per unit, then it's easy for me to say you can redeem partially or not. Right. So maybe I'll come back to you, Eugene, on this when I will send a message to the group to answer you these questions. I really have to find it out. Yeah. Okay, so Eric, this is the latest 1st of August bond. All right, you can see that it lasts from 10 years period from 1st of August 2022 to 1st of August 2032. And minimum applications $500 and the individual limit across all issues is 200,000. All right. So you can actually apply through different banks, through ATM. You can use SRS as well. Can do that. Now, in terms of coupon rates that they pay out, the annual return is first year is 2%. All right. Second year, the coupon rate is 2.86. Third year is 3.07, and all the way to 10 years is 3.29. Right. If I'm going to take an average per annum, what it means is that if you're going to put only 24 months, right? All right, year 1 and year 2, at the end of 24 months, then your average PA is per annum is 2.42. All right. And of course, if you complete the whole 10-year cycle, then your average return throughout the 10 years per annum is 3%. All right. So, of course, if you're only looking at 1 year, it's definitely low, right? But if you start to look at the second year, it's already 2.42. It's very close to CPF already. And the third year is already 2.63 and lasts all the way up there, right? So in today's terms, that this again now in July we look at it and say, hey, this is not too bad. It looks attractive as well, right? It looks attractive. But of course, in 2 months down the road, when this is become, assuming the coupon rate is paying, let's say 4%, and this turns out to be 3.5, then this does not look attractive at all, right? Just a few months ago, all these numbers are up to 10 years is only giving you 1.5%. Just a few months ago, you can actually go back and track the history of Singapore saving bond. Up to a few months ago, not even a year, it was only giving you 1%. It was pathetic. That's why nobody is interested to look at Singapore saving bonds. But trust me, the July tranche, this is August tranche, the July tranche, it was giving an average return of about 2.76 not only it is fully subscribed, it was oversubscribed. So trust me, this one is going to be oversubscribed as well. You know, people look at the return. You know, some of the people who want to play very safe in their investment, they are looking into this. Okay. So with that, I have complete my Singapore Saving Bond segment. Do you have any questions? Anyone? Okay, if there's no questions, then what we will do is this. I have picked 10 fixed income tools for today, for this month, and you all can start to look into it and make a comparison. So in terms of unit trust, this is something that you shouldn't be too stranger to you all, because it is the same 3 unit trusts that I have picked during our January gathering sessions. So we have an Asia High Yield Bonds funds, which give you an average gross of 12.88%. And then BlackRock Asian High Yield Bonds in Singapore dollars terms, 11.40%. And then I have Fidelity High Yield China Income Funds, which is 10.72% return. So this is the unit trust segment, part of the fixed income. The next one, which is part under the fixed income, is the REITs ETF. So we have the Lion Philippe ETF, which basically the price has come down, and then of course because of the price has come down, now the gross dividend yield has actually goes up. So right now it's giving 4.94%, and then we have Nikko AM Straits Trading Asia ex Japan, give you 4.15%, and then the other one is US High Yield Bond Index, which is the ETF as well. It will give you 5%. All these are listed in Singapore Stock Exchange, and you can actually buy and sell this ETF through the exchange. Short-term single premium endowment, based on what is available in the market, the NTUC has already fully subscribed, so you don't have to look at it at all. Great Eastern single premium, that has been fully subscribed as well. So we're only left with one single premium endowment, which is TIQ 3 years endowment plan, and this is a 2.3% per annum. This is slightly outdated. I will have to update for you all at the moment for this now. We go to this website because I realized that they have just updated to July, and my slides is still in January. So I have a RHB 2.25. And then the other one is the next one will be Bank of China, 24 months. So this is time deposit for these two FD for considerations. And the third one is Singapore Saving Bond, which is August tranche, and 10-year yields is 3%. Now, if you don't like the 10-year yields, you may want to say, look, will I be, if I want to look at just, will I be looking, perhaps you say that, 10 years is too long, and you say, are only interested in 3 years, you know, because since the single premium is only 3 years, so Singapore saving bond should be 3 years, then that's fine. Then you can look at 2.63%. But if you want to look at the 10 years, then this is the 3% 10 years yields. So as far as what is available in the market, these are the 3 fixed income tools for your considerations, and that's all for my presentation for tonight. So before I pass it on to Emin, any questions from anyone? Would love to take questions. Yeah.